Our next guest says that inflation-linked assets should take a permanent place in the investment portfolio. Here with us now to explain is Nancy Davis of Quadratic Capital. Nancy, great to have you here on set.
Great to be here.
You heard our conversation. What do you make of this all? How do you invest in this environment?
Well, I think the comments about the yield curve are spot on. The yield curve is lower now than it was even in the 80s, the late 80s. So we've never had this amount of inversion because, exactly to your point, Carter, consensus is that long-dated yields are going to fall. And there's actually a negative 1% in the derivative markets. In the swap market, it's even lower than the Treasury market. It's 102 basis points negative between the 2 and the 10-year swap rate. Wow. So it's just crazy. It's almost like you're paying a tax to buy long-dated bonds. Like, here, U.S., I'll lend you some money, but you get paid less to lend money longer, which doesn't make any sense. So the markets are definitely pricing for this low growth, disinflationary. It's priced for a recession, and that's consensus.
So historically, the way to play inflation, we're still in an inflationary environment, have been tips. But if you look at it, they really don't work. IVOL does work. So tips, to me, extraordinarily rudimentary, one-dimensional. IVOL is not. Can you speak to that?
Well, I'm the portfolio manager for the IVOL ETF, and it takes tips and it tries to solve the problems, which is exactly right, Guy. They're bonds. They lose money when 10-year yields move higher based on their duration, and then the only index is a consumer price index. It's like only using the Dow Jones in your equity portfolio. Even the Fed doesn't use the CPI. So a third of the CPI is rent, and it's a lagging number. So I think it's a good solution. And I do think, Melissa, to your point, inflation-protected bonds really should have a place in core fixed income portfolios, especially because so many of the indices, like the Ag Index, they don't have any inflation protection in it. So how can it be core fixed income if it's missing that key component of the market?
Yeah, and I very much believe in having inflation protection in your portfolio. We always want to have that for our clients. But I do get a lot of pushback right now where people are saying, well, if inflation's coming down, and a lot of people think it is, why do I still need those inflation hedges at this point in time? And I guess that would be my question to you is, how do those still have a place in your portfolio? Not saying I disagree, but I want to hear your thoughts on that.
Well, just like stocks, all markets move off of future expectations. The consensus is that peak inflation has happened. It's going to fall dramatically. So even if you look at the inflation-protected bond market, you see the break-evens are all around 2%, even though, to Guy's point, we just had our last print at 7.7. So yeah, it's priced to fall, but it's right at the Fed's 2% symmetric target. So why not have some diversification? I think, especially for retirees, if you're not in the labor market, you're not going to benefit from wage inflation. So you just have a higher cost of living. So why take a bet against it? And I think that's why it's a core in the portfolio.
Good point.
Hey, Nancy, so labor markets versus goods and services, or goods versus labor markets and services, which do you think is the more important driver for the underlying assets or direction of your fund?
Well, I think they're all important, but I think there's a lot of complacency that the Fed hiking policy rates is going to ease inflation in the future. And I think the challenge is the Fed hiking policy rates doesn't fix the labor market. It doesn't fix the geopolitical risks around the world. It doesn't fix the supply side delays that we're still experiencing because of COVID. So it's just hiking policy rates, and that inverted yield curve, that's crazy, right? A negative over 1% difference between 2 and 10-year swap rates just doesn't make a ton of sense. And it's because consensus is buy long-dated bonds, because we're going to be in a recession. We're going to be in a low-growth environment. The Fed is going to pivot. And I just think there are very few things that you can buy in today's environment that are trading at valuation levels below the late 80s. What else is there?
All right, Nancy, great to see you. Thank you.
Thank you, Melissa.
Nancy Davis of Quadratic. Carter, what's your take?
Well, I mean, this is just consensus moves so quickly. Just if you were to roll back the clock, my point is the last week in September, we had just crossed over 376 and people were talking about, my God, inflation will never end. And now all of a sudden, everyone's on the other side, inflation's peaked. The consensus responds to price. Price leads in every market. And while consensus might be lower now, I think it's probably lower than even consensus thinks.
Tim, I'm curious, do you think that the investing backdrop is better today versus late September? I mean, Carter was referencing late September because if we use that as sort of the benchmark, rates are flat. I'm wondering if the outlook is much different.
Well, to me, it's all where have prices gone on valuations and where have markets gone, and we're I don't know, we're 30% higher on semiconductors. We're at a VIX with at a 23 handle, and we've priced, we've had a major rally in the 10-year. That's not that bullish to me, even though I think we're further along in terms of the Fed messaging. And I kind of scoffed at the CPI number that was down 0.3% off of a 40-year high because of used car prices and a calculation in healthcare costs. I still think, I look at services inflation that outstripped goods inflation in that CPI number, in that PPI number. Those are the things to worry about. Jobless claims today that came out went down. The labor market remains very tight. So back to where would I be today versus back in September? I'm more cautious, mostly just because assets have priced in a lot of good news.